All right, good morning, everyone. It is, let's see, 8:41 on the morning of January 28th, 2021, and this is my pre-market workup. Got into the office a little bit later than usual. I'm usually here by about 8 a.m. And have my pre-market workup done, and then have my pre-market strategy complete by the time I start the video. However, a little bit behind schedule today, so I'm going to go ahead and start doing the workup here while I am broadcasting. And what that entails is putting on the risk ranges that are published through my consultancy, the consultancy firm that I use every day to sort of guide my way through the trading, market trading. And so that entails putting my risk ranges up on there are more risk ranges that are supplied, but I tend not to use the others. And so in order to sort of streamline my morning process, kind of skip over those and just go for the 10-year, the SPX here, in the low end of the range on the SPX keeps getting lower there. And the high end of the range on the SPX keeps getting lower. Yep, definitely. Yep, that's looking pretty much right now. This is looking as close to where's my here it is. As close to a bear flag as you can get, really. Who knows how long this bear flag is going to play out? It could be a month, so if I go back over to the SPY here, here's this consolidation area between mid-September and mid-October here until it decided to resolve which direction that it was going to go, and it was a continuation to the upside there. I think that sucked in a lot of bears right there, and there was sort of a wringing of the sponge for liquidity right here in this run right here. I know there were a lot of people who probably put on positions somewhere in this area right here who just got, taken to the cleaners on this run right here. So too bad, and that's one of the nice things about having a hedge fund consultancy company to guide my way through the ups and the downs, generally speaking, of the market. Fortunately, I didn't get sucked into any short positions in here and set myself up for the move with some long positions. Anyway, so here we have this consolidation for about a month in this price range, and it's really quite possible that this consolidation here could continue, for another month. So this started in late January. Let's see where we are in late March here, or I'm sorry, late February. So let's say right there, roughly. So if who knows? There's no telling. All of this stuff is just simply for guidance. Trading really is all about probabilities, the probability of success of a trade, and also money risk management. And so if according to Mandelbrot's equation, and it's been years since I've done it, essentially, if I risk no more than 0.5% of my portfolio on any one trade and cut at 0.5% loss, but then let my runners run to 0.1%, then I will have a winning strategy. And that's true. I do make steady money on trading, but the amount of money I make, is according to the risk that my portfolio size can handle. And so, it's tough. I've got a portfolio that's just big enough to barely scrape a living out of this thing, especially with expenses going up. Nothing's getting cheaper, So, okay, here we are. Here are a couple of trend lines here that I drew just this morning. Where exactly will, which line will this market, adhere to? Who knows? Maybe neither. Maybe this timeline, maybe that's too long, maybe it's too short. But in any case, if I've got at least something to go by. I put something up here, to kind of give myself some guidance. Then, I won't use this line or that line to trade off of. But if it starts adhering to one of these two lines with a third touch, see, there's a touch here, there's a touch there, and actually, I do get 3 touches out of this line. This one right here. So okay, anyway, it's all sort of a matter of putting the odds in your favor and then managing the risk. So there's some setups that are quite reliable, and one of them is definitely a bear flag and bull flag, and this is definitely looking like a bear flag, just classic bear flag. And there are also a couple of other things here too. So let me kind of clean this up a little bit. So there's that consolidation area there, right? And then you can see these dotted lines down here. That's a gap. That's a gap that's been left unfilled. And so there were a couple of gaps in here that went unfilled. It's now come down and is consolidating in this area right here. I think it's consolidating for another move down. That's my personal opinion. And I think it's going to make a move for this level down here to fill this gap. In technical terms, a technician, the unfilled gaps, to a technician is, an area of repair. It needs to come down and repair this sort of leftover business that hasn't been repaired. And as of right now, that's what it looks like it's doing to me. That's a rather simplified way of saying also that Hedgeye is forecasting the first and second quarter to be a slowdown in growth of GDP and a slowdown in growth of inflation. And that's bearish for risk assets. So does that mean that the next 2 quarters will be, bearish? It could be, but I imagine with the way the market likes to do things, they like to pull forward performance and then look past bad performance. So right now, the market is looking at the next 6 months of slowing, an economic situation that's slowing with kind of high inflation. Even though inflation is slowing, the inflation rate is still kind of high. And then looking to perhaps see another period of growth after the first 6 months. That's a little bit too far out for anyone to really discern. You can throw some darts, at anything more than 6 months out and have a sort of a general forecast. It's almost like trying to forecast the weather a month away. You can have an idea of what's coming your way and what season it is, and is it spring or summer, and what high pressure system or low pressure system is going to be moving through the area with what kind of moisture and temperatures and stuff like that. But you won't be able to nail it down until you're much closer, than a month away. You won't be able to nail the weather down. That's kind of what this is all about with stocks in the market and bonds and so on. So in my assessment right now, the market is looking to come down and repair this after some consolidation, perhaps even a little bit of a move up, a little bit of a relief rally there, perhaps. Hedgeye is actually calling for a crash to it. Not to this, actually. He doesn't do price targets like that. The Hedgeye guy, Keith McCulloch, he just calls direction and basically the forecast of the timing of it. So anyway, that's kind of, I don't have any stocks really that I'm looking at. I have my scanners open and there's some stocks that are up, there's some stocks that are down. Small caps I don't even really pay attention to anymore. There's enough moving with, between Tesla, Amazon, the Qs, the SPY, emerging markets, and here's this little, I have this on, it's a small cap that I just, it's on my scanner, and it's total junk, it's garbage. But anyway, I'll just get rid of it there. So, okay, let me get back here to my risk range levels and get those going again here. So, let's see, did it keep the 189? Yeah, all right, so it kept the ones that I've already done at least. 4, okay. So, TradingView can be a little temperamental sometimes. So I'm just going to go through and adjust these risk levels here. 14280, top end on the NASDAQ, and the low end is 13016. You know, the NASDAQ hanging around the top end of the range right here like this. You know, that's it's been really a good trade, a reliable, consistent trade here. The same thing with the Russell. It's just that the Russell has been close to the bottom end of the range for so long, it's hard to really choose a good entry on it. It's not as easy. The Qs have definitely been really quite predictable. Low end of that is 1892. Let's see the VIX. If he's calling for lower lows, he's calling for higher. Oh no, the VIX is the high end of the VIX here, saying 36.43. The high end of the VIX, and the low end of the VIX is above 20, which is definitely 1.93. Yeah, definitely quite high there. It's a Friday too, so things Fridays tend to be rather eventful. People typically don't like to go into the weekend, you know, with too much risk on their plates. US dollar high end is 97.48. Wow, that's a lot higher. That's a huge move in the dollar. And the bottom end is 95.24. So, yeah, emerging markets are still going to get beat up with that. Natural gas. How about that spike in natural gas yesterday? That was crazy, huh? All right, so I'm not going to do the risk ranges on natural gas. I'm not really interested. Gold, I am interested in. Let's see, gold, 1780 on the low end. And the high end is 1866. Wow. Okay. And we're at the low end of the range on gold, so you know this is the spot to start jumping in. There's the GLD. Oil volatility is trying to come down a little bit. Looks like it's trying to. USO's up. USO actually looks like it's at the high end. This is interesting. So USO is one that I'm paying attention to here because of the gap. I love gaps, by the way. So here's the bottom of the gap. I'll go back and I'll show you where the gap occurred. Here's the bottom of the gap and here's the top of the gap. This morning, if USO opened right now, it opened up really close to yesterday's high, just inside yesterday's high. I imagine that this thing's about to make another leg higher. So let's go back to the gap. So here's the gap, and this gap occurred in roughly the time frame, early March. So the rest of the market, I guess, you know, you could say, so that at the end of February here, right here, is when the stock market started to crash. And actually the oil kind of led that a bit. It's interesting. So U.S. oil, USO, United States Oil Fund, was a little bit late, a little bit delayed there in the crash. So here, roughly the 20th of February, is where the stock market, the S&P, the Dow, and the NASDAQ really started to crash and gapped down and really kind of took off to the downside. And so USO obviously started to go down there, but I wouldn't say it was really, I guess, it's pretty much, it doesn't look the same. It just looks different. So yeah, I mean, there's a move here from the low 90s to this point only a few days later in the low 70s. So yeah, I mean, it's a 20% plus move to the downside, but then it gapped. right here. And gaps are really where I like to pay attention to price movement. Gaps really they just always come back to repair themselves. And so here we are in this quad four downturn in the economy, but oil is just showing strength here, which is really strange because as the dollar increases, as the strength of the dollar increases, it's really quite typical to see all commodities, softs, metals, everything sell off. You know, as the dollar gets stronger, you know, you need less dollars to buy corn, cotton, gold, oil, so on and so on. But there's a complete dislocation between the strength of the dollar. Here we go. Look at that. And then that is bearish for commodities. But we have you know, some commodities that are just, you know, getting hammered by the stronger dollar, and other commodities that are doing okay. You know, and dollar being or oil being one of them. So I will be looking, and it could take another 2 or 3 months. I mean, it could take quite some time, but I will be looking for an opportunity to short oil right here at the top of the gap. That's at $68.80. I don't want to go long, even though it's inside the gap, and it really has hit that level back here. I mean, this is a technician's, you know, dream come true for it to hit these levels like this, pull away, then gather some more price energy and bust through. This is as obvious as it gets for a trader. I don't like to be long inside. I don't like to be long or short inside the gap. I want to play against the gap, to the downside here or to the upside. If it can break through and hold and then move forward, then you know, to the upside. However, so I will be looking for a short opportunity right here at $68.80 on USO for a trade. I do not. It can happen that it hits, you know, this price level, and then just says, okay, see you later. Never, you know, it'll be another 5 years before oil hits this, you know, 68.80 level again. That can happen, but it can also happen, and what I only the trade that I have, the idea for the trade that I have on this one is for it to hit here and pull back. And so I will be looking for more than a 1% pullback after it hits 68.80. It could come into 68.80 and kind of bobble around 68.80 and then pull back. And so I will be averaging in, you know, slowly. It just kind of depends on how things work. But then what can also happen is it can hit here, move above, confirm, and then continue further. So, you know, it's all a matter of, at that point right there, when, you know, it starts to hit this level, it's about risk management. It's about money management at that point. But that is the trade that I will be waiting for on USO. Okay, so moving on here to the risk ranges. Let's see. I use alarms on the NASDAQ and on the SPX and the NDX in order to enter on the Qs and the SPY. So I don't really Microsoft, Facebook, I'm not interested. I'm not interested in natural gas, even though it's supposed to be bullish right now. I played natural gas a lot already this year, and just don't really have, you know, I made my money on it, and this is Wyckoff distribution. This is, you know, just I'm looking for things that are in distribution. And Amazon, which is the title of this video, Amazon and Tesla are definitely in distribution here. So I'm going to do the levels on Amazon, which are 29.66 on the upside. Oops. Wait a second. Where is my price? Why am I not getting this? Sometimes TradingView. Oh, I see. Okay, it's because I have the color on. I was on brush, so now that I select the line, I can change the coordinates there. Okay, so 2096. I think I saw 2966. 66. top end. Get rid of those dots there. And for the low end is 2603. Then Tesla, wow, Tesla yesterday. I was really surprised by Tesla. I did make a couple of trades on Tesla yesterday. Let me kind of get some of this stuff off the screen here. This was a $100 plus move on Tesla to the downside yesterday. I had no suspicion. I really didn't think that Tesla would make this huge of a move yesterday. Let's see. That's an 11% move to the downside, 104 points to the downside yesterday. That was a huge move. And it's still, here it is in distribution, and it's only getting started. This is only the start. It's really quite possible, after this right here, Tesla could be back down in, the 100 handles soon. I'm talking soon too. It would be crazy. Anyway. So, and I only recently just started trading Tesla, but this is definitely a distribution pattern. Amazon distribution pattern, definitely. Look at that. Up high, take profits, take profits, take profits. Sell to the retail, sell to the retail. Talk up stocks, so on and so on. Take profits. Now it's in distribution, total distribution. I imagine Bitcoin's probably really quite similar. Yeah. Oh, the interesting thing that happened here with Bitcoin, actually. This trend line, I've had this trend line in place now. Let's see, I put this trend line on here probably somewhere around the 18th of May of 2021. And here it came right back down to it and bounced, had a really big bounce. Yeah, broke down below this 42,000 level, really let go. And came down to this support line right here and bounced. I imagine with the way things are going, and Bitcoin, how much further out on the risk curve can you get than Bitcoin? There's no dividend. It's as risky as you can get. So when it's risk on, when we start moving back into quad 2 economic conditions again and away from quad 4, when the rate of change on GDP is positive and rate of change on inflation is positive, then risk on, Bitcoin back. But right now, risk off. There it is, and this thing's been risk off since mid-November, early November, and it's just it's risk off. So I imagine this is what I imagine happening. Boing, with those sound effects too, actually. So a little hop again above this, down, a retest, maybe another retest, then it starts to drift down, and then, all right. And so that means all of the derivatives, all the Bitcoin derivatives are going to be bearish as well. Riot, I remember when Riot was going for 75 cents a share, back here. Let's see, let's go to auto. Here's the daily. And I had this thing, look at all this laser light show I had. I traded Riot back here a few times. Let's see, starting, I think probably 2018 or so, or something like that. I don't remember. I'd have to go back in my records and look. But yeah, I had this thing mapped out and was trading it and so forth. And was actually completely incognizant. Didn't have, there's one day I opened it up, I was like, whoa, wait a second. How'd this thing end up at, $80 a share? Totally just forgot to pay any attention to it. And here, this is a distribution pattern. This is also a classic distribution pattern right here. The high, the almost next high, then the next sort of hope right here, and then, you know, down. Now it did happen to come down to the support area right here and continue forward for quite some time. But yeah, here it is. This is it. Yeah, I'd say Riot is probably on its way back down to, you know, well, at least this $9, this first support area. Then it'll probably start leaking down again, you know, back into low prices, very low prices. You know, who knows? Nobody outside of, you know, some real sort of Bitcoin or cryptocurrency entrepreneurs know anything about Riot, know anything about, you know, its existence, even what it is, what kind of a Riot coin, I don't know. So, yeah, all right. Yeah, I'm looking for opportunities to go short. I think I have a little bit more time to wait until we see the next leg down and I really start to participate. And so in the meantime, I will be just sort of utilizing the risk ranges in order to, you know, look for high probability trades in the direction of the trend. And that's it. Okay, everybody, good luck out there. Keep your wrists tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you on Monday morning's strategy session. I am out.